Volatility top of mind for investors. What could investors expect as the year moves forward? Let's bring in CFRA's Chief Investment Strategist, Sam Stovall, and DeWardrick McNeal of Longview Global, also a CNBC contributor. Good evening, gentlemen. DeWardrick, Europe went into a bear market. They're expected to feel the pain a lot worse, the ripple effect from Russia and Ukraine because of the proximity. Euro's at a 5-year low. Are we next? Is the U.S. market and the U.S. economy next?
Well, I think what we're seeing now is how resilient our economy is, but I think we do have to be concerned given what we're seeing. But I think there are some bright stories for investors with respect to Europe, Sarah. If you look at the defense sector, for example, Europe has had a paradigm shift in thinking around investing in this sector, particularly Germany. So there's a lot of, in my view, tailwind and long-term opportunities in the defense sector in Europe. But let's hope that the U.S. is far more resilient in terms of its market than we're seeing in Europe.
Do you think that's been priced in, DeWardrick, to U.S. defense stocks, which have fared better? But if we really are seeing a paradigm shift, couldn't that last for several years, decades even?
I think for European stocks, for sure, on the defense side, these have been underinvested in Germany for a very long time for historical reasons. But I think you're starting to see that the Europeans, particularly the Germans, believe that we have to invest both at home in terms of our defense needs, but also look to export some of our defense technologies to other places, to some friendly countries. So I do think there is some tailwind on the European defense stock side.
Mm-hmm. Sam, what about you? It felt like today, today was the worst day for stocks in 17 months, on top of what we've already been through. It had a feeling of economic weakness, even though we saw Treasury yields higher. And a lot of stocks that have a lot of exposure to Europe in particular got slammed. PVH, a retailer, Ralph Lauren, Tapestry. It feels like investors were looking at that exposure of business to Europe and really pushing the sell signal. How would you characterize where we are after such a deep sell-off?
Well, I think the first question that investors have is, was this the washout day, the capitulation day? And I checked with our analysts over at Lowry Research, our CFRA's technical analysis arm, and they said that while selling pressure has been the strongest today that it's been in several months, it is not at their 90% level that they would regard as a washout period, and that therefore we probably could have some more downside pressure to go, even though it felt like everybody was throwing out the baby with the bathwater.
What about technical levels, Sam? What are you watching?
Well, I'm looking at about 3,800 on the S&P 500. That equates to a Fibonacci retracement level. Also, if you do believe in head and shoulders patterns, that would imply what the decline would be based on the neckline versus how high we went in early January. And that would equate to just around a 20% decline for the S&P 500. A similar retracement for the Dow would bring it to around a minus 19% or about a 30,000 level.
So more pain ahead. DeWardrick, how are you reevaluating global growth this year in light of all of these issues?
Well, one of the areas, of course, I'm watching is what we're going to have out of China. We just had the National People's Congress take place over the weekend. It seems like there will be more fiscal and monetary actions out of China. That could be a potential growth spot, but there are also a lot of downside risks looking to China as the growth engine in 2022, Sarah.
What does that do, Sam, for earnings expectations? Like they keep coming down.
Earnings expectations right now certainly are dramatically lower for 2022 compared with 2021. 47% is what S&P Capital IQ shows for last year, but only about 6.6% growth for this year. And I think that the further that we go with higher energy prices, obviously those numbers will come down. There's an old adage that for every $10 increase in the price of oil that goes on for an extended period takes away 20 basis points of real GDP growth. So the longer we have higher energy prices, the more of a drag it's going to have on the economy and obviously on earnings.
DeWardrick, Sam, thank you for joining us tonight.